going on, guys? Finally get to make another damn video. But this video is kind of backwards from what my other videos are, but I figured I'd go back to the basics and speak to some of the beginners and talk about the dividend basics and just make this video hopefully pretty short and sweet and talk about the minimal information that that you need to know to get started to starting investing for dividends. So I'll get to it. So anyway, obviously I wrote down a few terms that are important for this video. Stock, I'm sure you know what a stock is. It's a piece of a company. Obviously you could buy a stock for any public company that's out there. So piece of company, right? Now, we all know what a stock is, right? Obviously. If we clicked on this video, we know what a stock is. Now, if you're looking to invest, to be a dividend investor, then obviously you probably know what a dividend is as well. But to keep it simple, most of the larger companies do pay a dividend. And basically, this is just a way of rewarding shareholders. So the larger companies they'll pay a portion of their earnings out to the shareholders in a form of a dividend. So this is basically just payment for owning stock. For owning that, right? Simple. So if you own the stock, you'll get a dividend. Monthly, quarterly, semi-annually, whatever. Depends what kind of stock you own. So now, what else do you need to know? Do you just buy any stock that pays a dividend? No, obviously. So another important term is the yield. Now, this information, yield is pretty much everywhere. So no matter who your brokerage is, no matter what website you go to and you pull up a stock, they're going to mention the yield. If it's blank or not applicable for them, or zero, that means they don't have a dividend. If it's 1%, it's a pretty weak dividend. If it's 3%, it's probably, that's typical average starting dividend. Most around 2 to 3%. If you see any around, say 5 to 7% range, it's probably a real REIT, a real estate investment trust. If you see anything from maybe 8% and above, I would just say beware. So anyway, how you get the yield is basically it's the dividend. It's the annual dividend. So if they pay quarterly, you take that dividend, you times it by 4. That's what the annual dividend amount is, and you divide it by the stock price. So that's how they get the yield. Obviously, if it's a monthly dividend, you times it by 12 and you divide it by the stock price. So the yield will go higher, obviously, as the stock drops. So that's why we say, you want to buy the stock when it's on a discount. Another important term is payout ratio. What this is, it basically tells you how much, of their earnings they pay out per share. So if it's, how much of their earnings they're paying out in dividends. So if it's, say, 50%, they're paying half of their earnings out in dividends. If it's 100%, they're paying all of their earnings out in dividends. And that's not good. If it's over 100%, that means they're probably, borrowing money to pay out in dividends or taking it from the capital to pay out in dividends. So it means they don't have enough to pay out in dividend. So the idea here is you want to stick with a lower payout ratio, typically below 70%, ideally. So basically it's the amount of, it's how much earnings are paid out in dividends. So you could take, I probably should have looked this up before, but I believe it's just dividend divided by earnings. But you get the gist, right? You get the gist. And then there's dates. when you're a dividend investor, you need to know these dates. What is the most important date? That's the ex-dividend date, right? The ex-dividend date. And what the ex-dividend date is the date that you need to own the stock to get the dividend. It's basically the day. The ex-dividend date would be, say, for example, January 15th, right? 2019. If you own the stock any day prior to that date, you're getting that dividend. You're getting that announced dividend, whether it's quarterly or monthly. If you own that stock on the 15th, you do not get that dividend. Meaning if you purchased it on the 15th, you do not get that dividend. So a lot of people, they buy stock for the dividend and they kind of swing trade, make a profit. They try to do that. But most dividend investors, they typically just don't care because they're buying and holding forever. But this is an important date, especially if you're just getting into a stock and you want to get a piece of that dividend right away. You might want to just check out the ex-dividend date. You probably don't want to buy it the day before the ex-dividend date because the stock price is usually a little higher than norm. Actually, and the ex-dividend date, the stock price will decrease by the amount paid in dividends. So that would be a good entry point, but you have to wait another quarter or so to get the dividend. There's a couple other dates. There's record date, and that's the date that they record the dividend in their books. There's declaration date. That's the date they announce the dividend. And then there's payment date, the most important date for us. That's when we get paid, right? So, that's what we care about, the payment date. So obviously all of these dates typically are within the same month or range or so. Some of the monthly dividend payers, they announce like 3 months ahead. So the declaration date, say, will be January 1st. The ex-dividend date will be 15th. The payment date will be January 31st. And then the declaration date for the next 2 months will still be January 1st because, the payments, they announce February and March payment as well, payment terms. So anyway, this is the basic terms and what you need to know to be a dividend investor. And again, the idea of being, actually one more term, DRIP, right? Sorry, who can forget this? DRIP. DRIP, right? Dividend reinvestment plan. So most brokerages, not Robinhood, but most brokerages offer the DRIP method. What that means is when you buy the stock, obviously with a dividend, you have to select where that money's going to go. Are you going to get that money in cash, or are you going to reinvest that money back into the stock? And the good thing about the DRIP method is it lets you buy fractional shares. So if you buy one share of a company, obviously that dividend that's reinvested is not going to buy you an entire share. You're not going to have enough money from the dividend. But it'll buy you a fraction of that share, 0.01%, 0.02% of that share. And it adds up. So if you're investing in a company, that's a no-brainer. You want to be in there for the long haul, forever, then you want to select the DRIP option because you don't even want to look at it. You just want to put all the dividend back into the company. Keep buying shares. And then when you get new money, you could just buy, additional shares on top of that. Robinhood does not offer that, as I mentioned. Which is good and bad because it makes you take all of the dividend money and, do what you want with it. So obviously if you're reinvesting, I still say I do DRIP, even though the DRIP option is not available. When I get my dividends into my account, it goes in directly into the buying power. I take that money and I reinvest it into companies that are on sale. So the DRIP option, obviously, it would automatically buy the stock, whether it's high, whether it's low, it doesn't matter. But when you don't select that option, the money will go into your buying power. So you can actually just take, and reinvest it yourself onto the discounted stocks. That takes, a hell of a lot more work. But, in the end, your average will be good. Your yield on cost will be good. Yield on costs, I didn't mention that on here, but of course, it's basically, obviously we went through yield, so it would be annual dividend divided by the original stock price, not the current stock price. So when you see yield, like on a brokerage account, on Yahoo Finance, that's, today's yield. Yield on cost would be today's dividend divided by original stock price, stock purchase price average. So keep in mind, if you own a stock, say for 5 years, obviously, the capital probably went up, but your original purchase price is this. They increase that dividend, the next 5 years, you probably could have a yield on cost 7-10%. So starting yield, you're not getting that on a respectable company that's safe. You're going to get 2 to 3%. So, but years down the road, you invest in a company like Home Depot who does, on average, around 23% over the last 7 years. Increases. That's insane. Increases. So your yield on cost. Look out for Home Depot, man. I mean, where are they going? Who's competing with Home Depot? Lowe's? No, I don't know. Anyway, I don't want to get into individual stocks. So that's yield on cost. So yeah, the idea, back to the drip method and reinvesting. When you open a brokerage, whether they offer the drip option or not, that's up to you. It's simple. What I would say is, if it's a no-brainer stock, like say Procter and Gamble, if it's Apple, if it's something that okay, they're probably not going anywhere, and I want to continue investing in that company, then you want to select the drip option. Another good thing, when you buy the fractional share, you get a fractional dividend. I didn't even know that until I opened my son's custodial brokerage, but it's pretty cool, honestly. Yeah, I don't have it. A little jealous, but like I said, I enjoy reinvesting my dividends to where I want it to go. So I take my new money plus my dividends, and then I buy stocks on sale or stocks to meet my monthly goal. I have a monthly goal. So yeah, that's the drip method. So that's basically all the terms I think you need to know. Yield on cost I didn't write down, but yes, that's also important. So yeah, the idea, you don't need to know much to get started, to be a dividend investor. Dividends are great because you buy the stock, you just leave it, and you get paid. It's passive income. I mean, everyone loves that. Everyone loves throwing that term around, but dividend investing, in my opinion, that's the easiest way to get involved with passive income. So obviously you can get started very easily nowadays. There's so many brokerages that are free. As I said, Robinhood, I believe M1 is also free. There's a couple others, Acorns, or I guess it's $1 a month, but you get the idea. You don't have to go to the big banks and pay these brokerage fees, have a minimum balance, pay commissions on trades, $6.95. No, you can get started on these apps, and you don't have to have, there's really no minimums, and the minimums are low if they have any. Robinhood doesn't have a minimum, and you get a free stock just to start. If you click, I guess I'll attach my link. If you don't have a brokerage, I would certainly recommend Robinhood because it's more free. You can pretty much invest in almost any stock besides the pink sheet stocks, which is good. So, like I said, I'll attach my link if you want to sign up, and you get a free stock once you sign up, as will I. I'm not gonna lie. So, I mean, it's probably a $3 to $4 stock, but you get the idea. Right off the bat, you're not even putting in money, and you own a piece of a company. So it's a good way. It's a good idea too to get you started. Another recommendation: if you're starting out to be a dividend investor, don't start out just throwing all your money in. Say if you have a good starting amount, just start small. A couple hundred here and there. Put in additional money as you get paid. I would say learn as you go. Don't put $10,000 in and you're learning. Put a couple hundred in. Buy what you think. Do some research. And learn as you go. If you don't want to do the research, you can still do it. I would recommend ETFs, exchange traded funds. Those are pretty much, very diversified funds that own a little piece of multiple companies. 50 or so companies. So it's an easy way out if you don't want to do the research on individual companies. I like to invest in individual companies. You can read their balance sheet, income statement, etc. It just keeps it fun and exciting. I also like them, because I buy their products or so, or I actually, do eat there. Sadly, I go to McDonald's sometimes if I take my son. But so yeah, I think McDonald's is safe. Do you? Who knows? But they pay a dividend, a nice dividend. They increased their dividend pretty nicely the last quarter. So anyway, I just wanted to go through the basics of dividend investing, of getting started. You don't need much. You need a phone. You need the internet, a book. Buy books if you like reading. I don't read, so I just listen to videos. So it's pretty easy. It's pretty simple. And it's something that I would recommend if you're in your teens, get started. If you're in your 20s, 30s, 40s, 50s, get started. Why not? Obviously, if you're older, in your 60s, and you're already, retired, or you want to retire very soon, you're going to take a different approach, but it's still a good idea. If you have money to put, to put somewhere, don't leave it in the savings account. Why not play the dividend game, So, hope you enjoyed this video. I figured it was time to redo kind of a dividend basics video for newbies, because I feel like it's something that everyone should learn. God knows they're not teaching this in high school or college, but there's a ton of great people on YouTube. PPC Ian, he's awesome. He does his channel is basically only about dividends. Another channel I recommend, Financial Education. This guy Jeremy, he talks about everything, and he's very entertaining, so it keeps you excited. So, couple shout outs there. Have to, because they got me, they taught me a lot into investing. So anyway, hope you enjoyed the video. Leave a comment if you are a dividend investor. Let me know what stocks you like down below. If you're just getting started, if you have any questions, please leave them in the comments, or I will also link my Instagram page, Broke Investor. I have I share a lot of my investments. If you're curious of what stocks I own, I'll share my Instagram page as well. But anyway, time to go to work, and happy investing.